What's the purpose of investing our hard-earned money into the stock market? Of course, the underlying reason is to increase our wealth over time, to turn that initial investment of just a few £100 into something that could be worth 6 or 7 figures at some point in the future by regularly cost averaging our way into the market and letting the portfolio compound over time. But what's the point in having a huge account balance if you don't use the money to change your life for the better? The goal for me personally is to live on my own terms, doing what I want, when I want, retiring early and not having to rely on any single source of income. But whatever your goals are during today's video, I'm hopefully going to help you guys work towards them by showing you guys some formulas, some strategies and some figures that you can work towards in order to achieve your own financial goals. So if that sounds like something you're interested in, be sure to stick around. But before we dive into it, a big shout out to Genuine Impact, who are an investment research app who have kindly sponsored this video. You can use the Genuine Impact app to discover new investment opportunities, track your portfolio and compare different stocks and funds in order to help you take control of your investments. It's a great little app to use which you can download by clicking on the link down in the description below. And as well guys, if you do download the app, be sure to let me know your thoughts down in the comment section too. So living off your investment portfolio, it's certainly a goal that I am personally striving for, but how much money will I need in my investment account in order to turn this goal into reality? Well, there are two different strategies in order to live off your investment portfolio. The first one is drawing an income from the capital growth, and the second one is using dividend payouts. But before we discuss these strategies in a little bit more detail, firstly we're going to need to define how much money we actually need to live off. Now, of course, this will change over time with inflation because £40,000 today in annual expenses will not give you the same purchasing power of £40,000 10 or 20 years from now. And I know many of you guys watching this video are certainly going to be ambitious, so your living expenses today may also not be a fair reflection of what your desired living expenses may be 5, 10 or 15 years into the future. So that's certainly something to bear in mind whilst you're doing this exercise. Now, when you're working out these calculations, guys, be sure to also account for your desired lifestyle expenses at some point down the line. And you can do that by taking that cost figure and adding inflation to it to the specified time period in which you desire to live off your investment portfolio. And the way in which you can do this is by going onto a website called smartasset.com, and I'll leave a link to this tool down in the description below. So first up, we simply need to add in our total desired lifestyle expenses, which based on today's money, we're going to put in as £41,000. The rationale being based on a which survey in which I found online. Apparently the luxury level of retirement level is around £41,000 per year in income. So what we're now going to do is actually account for inflation over the course of the next 20 years. So we're going to take this to 2041 being our desired retirement age, which therefore gives us £74,000 in which we'll need from our investment portfolio 20 years from now in order to acquire the same purchasing power that £41,000 would buy us today. So the next question is, how much money will we actually need within our investment portfolio 20 years from now in order to be able to draw £74,000 per year in income from it? Well, this is where we're going to talk about step number 2, which is to calculate the required investment portfolio value in which we're going to need. To do this, we're going to use the rule of 4%, which means £74,000 must be the equivalent to just 4% of the total value of our investment portfolio. Now, the rule of 4% is a well-known financial planning rule which assumes your portfolio can achieve a minimum of a 4% return per year in fairly low risk assets which you can live off during retirement. Now, to calculate this, we can multiply our expenses of £74,000 by 25, which gives us our target portfolio of £1.85 million that we need to achieve in 20 years from now. But how on earth do we achieve an investment portfolio value of just shy of £2 million? Well, let's try and break it down in order to make this feel a little bit more achievable. Well, a simple investment into an S&P 500 ETF over the course of the past 20 years, adjusted for inflation, would have given you a real rate of return of about 12% per year. Now, of course, past performance isn't always indicative of future results, but we're obviously going to have to use some kind of number in order to get a baseline. However, do feel free to play around with these figures based on your own investments in which you're making and your own personal forecasted return on investment in which you're expecting as well. So to calculate how this looks in practice, we're now going to dive onto a compound calculator, and we are going to start with an initial balance of £10,000 within our investment portfolio. We're then going to add in that interest rate of 12%, and we're going to let the portfolio compound over the course of 20 years. We're also going to make regular deposits into this investment portfolio because we're going to assume that we're going to be using a stocks and shares ISA, which is a tax-free investment account over here in the UK, which you can put £20,000 per year into. into. So when we break that down from a monthly point of view, we can put in the equivalent of £1,666. I'm also going to increase the annual inflation rate by about 1% per year as well, driven by the fact that due to inflation, I'm also going to expect that the government will slowly increase that ISA amount limit over the course of the next 10 to 20 years too. If we then calculate that figure, it spits out a total forecasted investment portfolio value of the exact figure in which we're after of £1.85 million. Now, of course, there are a couple of factors in which we're going to want to consider. Now, the first and probably the most obvious thing to call out is the £1,666 per month in monthly additions into the investment portfolio may seem extremely steep and perhaps even a little bit unachievable. But consider you can just afford a couple of £100 into your investment portfolio per month right now, but perhaps 5 years from now you get that promotion at work, you pursue that business venture, or even start a side hustle. That couple of £100 in disposable income in which you have today may turn quite quickly into £2,000, £3,000, £4,000, or even £5,000 at some point down the line. And 10 years from now, it could even be more than that. The £1,666 should just be used as an average over the course of your investing lifetime. Similarly, the rule of 4% assumes that you only actually want to live off the equivalent of 4% of the total value of your investment portfolio. And it also assumes that you're probably going to be investing into relatively low risk assets that only actually give you about 4% per year return. But if you have a higher tolerance for risk, then you can probably look to afford to live off 5, 6, 7% of your investment portfolio value if you're investing into slightly higher risk assets that give you that slightly higher return on investment too. And as a result, you'll actually need far less in your investment portfolio account in order to be able to live off it. So that's strategy number one, to simply live off the capital gains within your investment portfolio. Of course, no strategy is perfect, but if you let your investment portfolio compound over time, you'll probably be able to live off a percentage of it at some point down the line. Strategy number two is to build a dividend investment portfolio and simply live off the dividends. Now, in order to be able to achieve this, we're firstly going to need to assume that we're going to be investing into either A, high dividend yielding stocks, or B, high dividend yielding ETFs. So here are a random group of high dividend yielding stocks in which I've put together in this dummy investment portfolio. Now, the first thing to note here is that all of these companies in which I have listed are United States based companies, but the current market prices in which I'm quoting for these stocks are actually put into pounds. The reason being I've converted them from US dollars back to Great British pounds to make this all applicable to every single UK investor out there. The next thing to note is that the dividend per share as well as the dividend yield may not read exactly how you've read it on websites like Yahoo Finance as an example. The reason being that over here in the UK, if you invest into United States-based companies that pay a dividend, you will have to pay a tax rate of 15%, which is automatically deducted from the broker in which you use. So because of that, I've multiplied this number by 0.85, or the equivalent of deducting 15% from the dividend per share and dividend yield amount. Then finally, we've broken down that £74,000 across all of the 12 stocks, which means we're going to need to acquire a dividend income on average per year of about £6,166 from each stock within this dummy investment portfolio. Now, also bear in mind, I've obviously accounted this on an annual basis, but some of these stocks may pay dividends monthly, quarterly, biannually, or perhaps even on an annual basis. So as a result of having all of this data, I've been able to calculate the total number of shares required, which is simply the required dividend income divided by that of the dividend per share amount, which gives us the total number of shares. Then to acquire the cost basis, I've simply then multiplied the number of shares required by that of the current market price, which you can see the higher the dividend yield, obviously the less amount in which you need within your investment portfolio. So obviously AT&T with a high dividend yield of 6.32%, you only need about £97,000 invested into AT&T in order to acquire that 6,000 and a bit pounds worth of annual income. However, on the other end of the spectrum, companies like Walmart, who pay a slightly lower dividend of 1.26%, obviously have a cost basis that's certainly higher of just shy of £500,000. So as you guys can see from adding up the total cost basis, we're going to need an investment portfolio value of just shy of £3 million in order to achieve £74,000 worth of dividend income. Now, of course, as with any strategy, there also are a couple of factors in which you're going to want to consider. The first one being, if you reinvest your dividends, you'll acquire more shares over time, and as a result, you'll drastically reduce the time required in order to actually achieve the desired investment amount in which you want. The second one being that some of these companies have actually increased their dividend over the course of multiple decades. So because of this, at some point down the line, at some point in the future, the required shares in which you actually need may be slightly less if the dividend yield is actually higher. So because of that, you can slightly offset some of the amount from your target investment portfolio value. So in summary, they are the two common investment strategies in which you can certainly use in order to actually live off your investment portfolio. But be sure to let me know what your thoughts, plans, goals, and strategies are in order to be able to achieve the exact same thing at some point in the future as well. And a final thank you to Genuine Impact who have sponsored today's video. Be sure to check them out, guys, by clicking the link down in the description below. And if you enjoyed the video, guys, be sure to drop a like on it, subscribe to the channel if you're new around here, and with that being said, I'll see you over in the next video.